Good afternoon. Hello. Thank you for joining today's webcast. I'm so sorry that I'm a little bit late. We had a little bit of a technical issue to clear out with the screen share. I hope everybody's enjoying this great, beautiful weather we're having, and certainly can't be too thankful for it, and as we can't be too thankful for the glorious markets that we're having this year. David is traveling to see clients today, so I will be talking to you about the macro environment and our portfolios. My name is Diana Avigdor, and I am the head of trading here at Barometer Capital. My role is to look at the market in its micro form and to try to understand where the next short-term move will be coming from. This could be timely for those of you that join us weekly, as my presentation usually has a more local flavor to it. But I will go through the charts that David likes to look at, which do delineate the long-term and the short-term, and definitely drives our top-down decisions of whether to be invested or not. I have compiled a chart pack from the last week that I've found interesting to share with you and relevant to what the push and pull is in the market currently. And remember, it is always about the probabilities and the potential depth of impact, as this is definitely not an exact science. And, predictions are so often not achieved by many predictors on the street, as I always like to remind people how often the market just does what it wants to do as opposed to what people are predicting. So let's just start. And finally, I will go through to what we've changed in the portfolios over the last little while. So let's begin. Markets have definitely climbed walls of worry this year, all around the globe, really, not just here in North America. And although last week was a little flat and uninspiring, nevertheless, the rally in markets have defied all expectations, and as usual, is doing nothing that dozens of strategists are saying it was supposed to do. So they're all ratcheting their end-of-year targets upward, and the rally keeps eclipsing Wall Street expectations. At the same time, and this has been going on for a very long time, probably until the last month or so, sentiment indicators have been really, really low all year. Anyone I spoke to this year either worried about inflation or worried about recession or stagflation as reasons to be bearish, all good explanations. And the unique thing about this year's market is that you could potentially explain the possibility of either scenario as conflicting as it may be. Yet reluctantly, people are investing with worry. Strategists all called for lower year-end targets and kept waiting for that one economic data that was going to prove their points. So sentiment and markets in opposite directions. To be fair, earnings have been very, very good. And this chart shows you the estimated next 12-month S&P 500 operating margins, and they're at all-time highs at 18.24%. This is important and plays right into profit margins, which are also very, very good in the aggregate. And I'm not talking about NVIDIA's margins, which are at 75%. And forward earnings expectations are still rising. Looking back since 2022, profits drove most of the returns. We can break down the S&P 500's year-to-date return into gains from profit growth, multiple growth, which is valuation changes and dividends. Here is what it looks like. Earnings growth contribution was 7.5 points. Multiple growth contributions was 4.5 points. Dividends, 1 point. In short, about 66% of the overall return of the index's year-to-date return has come from profits, both retained and distributed in the form of dividends. And so I harp on this subject a lot because at the end of the day, this is a market of stocks, and the stocks have to perform as evidenced by earnings, and we have seen that working pretty well. Looking back over the past 5.5 years since 2020 COVID, the S&P 500 has gained 123%, and that return could be also broken in to earnings growth being 76% of that growth, and multiple growth as well as dividends, the balance. Um, some say that less than a quarter of the return over the last 5.5 years since 2019 has come from multiple growth. Over 3 years, over three-quarters of the return came from fundamentals, including profits that were returned to shareholders. And so to some, this doesn't scream bubble or any kind of irrational market. It just, it tells investors that American companies have figured out how to grow sales and profits through all kinds of economic indicators. Now, all this that I'm talking about, this great earnings growth and dividend growth and buybacks, has been a big theme in the market, and it's not lost on asset holders. Foreign held US equities as a percentage of foreign held US financial assets is at a high not seen since 1970s. So the US has definitely been a great place to invest in. But now there are also options for diversification. We've done really well here, and we can look at other stuff. The chart that's in front of you is Japan, breaking out of a very, very long base. This is Singapore. This is China. This is Peru. Now, we're not invested in Peru, but you get the point. And this is Canada. We are invested in Canada. As a matter of fact, global equity breadth is breaking out really strong. So it's an everywhere thing. And finally, some global diversification is possible. And investing here at home also works very, very nicely. The way we look at the world, we look at breadth indicators, long-term and short-term. Long-term, everything looks good. But our short-term indicators are showing a little bit of softness, as you can see in the chart on the right. In this slide, the left is long-term and the right is short-term. So long-term is still looking great. Short-term is a little bit sloppy, a little softness. This is bullish percent for world equities, which is looking very good short-term. But the 10-week is a little weaker. Now, it may resolve, but we will see. Bullish percent for world equities, looking pretty good. This is bullish percent for, this is bullish percent for Canada. Canada is looking very good long-term and short-term, better than what we've seen in the previous all-world indicator. So bottom line, we're watching for the resolution of these short terms. And there's many things that are going on. We're ahead of a looming US government shutdown tomorrow. It is month end, so there is a little bit of rebalancing. We are waiting for earnings for third quarter, and we just finished balancing out a really large quad which last Friday, which did create a lot of flow in the market that kind of pinned the situation. So we'll see how that resolves. Now, this is normal. This can happen here seasonally. It can happen at this point between the end of the summer and the beginning of the new earnings season. And like I mentioned, the US government shutdown is looming, which means that we're expecting important economic data this week. Most important is the non-farm payrolls on Friday. So if the government does shut down, we will not get that all-important labor data. So despite some near-term softness, we've seen unemployment, we've seen a little bit of volatility on employment in Canada as well. Economic data out of the US was very good of late. The chart in front of you is GDP growth. This spring was much stronger than previously thought and printed a 3.8% number. Now, what we have actually seen, we have seen a very nice development. Small caps have also joined the party here, and I will go through some of the reasonings and what we have been doing with that. We have gone down a little bit on the market capitalization for our investments. The small caps are a lot more levered to the domestic economy, a lot less able to afford tariffs. But I guess something is working for them. Either tariffs are not coming through as high as expected, or they have supply chain pricing or final pricing power to be able to maneuver that. Well, PCE in the US was just 2.7%. In Canada, it's actually lower, the inflation number, so not so high. Prices have not really been going up all that much. And the global trade, something that we have been recommending to clients as a diversifier at this point, is arguably a smaller cap trade overall, as the US is the largest cap. But even in the US, Canada, we've gone down the market capitalization curve a bit with names like Major Drilling, for example, but more on that a little later. One of the things that we've seen in the small cap world, we've seen earnings estimate charts that show that although estimates for all caps are moving in the right direction, there is something happening for estimates in the smaller cap cohort. Look at the red bars for Q1, Q2 26, Q3, Q4 26. We're seeing earnings estimates that are quite high. Not that the blue line is weak, looking at 18% for Q1 26, but 27% is also very good. So like I said, we've moved down the capitalization curve in the portfolios as well a little bit. We've seen some good pricing action on some smaller names in Canada have been acting really well. But back to macro, the average return for the S&P 500 after the start of the cutting cycle is very decent. So with the backdrop of higher earnings, good risk appetite for small caps, growing economies, the longer term outlook is intact for now. From a trading perspective, what I see is strong dip buying mentality. We have strong demand from the retail community, and this is no longer mom and pop or kid trading from mom's basement. These are large asset pools with well-informed individuals trading smartly. Look at the daily retail net demand by month in 2025 in gold bars relative to the average 2020 to 2024 period, of course, spurred by COVID, a time we know it triggered quite a lot of retail trading. It has not fizzled, quite the opposite. Back on the small cap theme, this is a chart from Morgan Stanley that shows positioning across the three major markets over 1 month, 2 weeks, 1 week, and current. The dark blue is current. And look at it over the Russell 2000 position has been quite strong. Now, people talk about valuations being very high. I thought this was interesting, I saw this week, and if correct, plays into why all dips have been bought and why the long-term outlook is okay. Savita Subramanian from Bank of America says today's market highs are justified. The attributes inherent in the current mix of members, including less financial leverage, lower earnings volatility, increased efficiency, and more stable margins than in decades past, help to support the towering valuations, she argues. The index has changed significantly from the 80s, 90s, and 2000s. Perhaps, she says, we should anchor to today's multiples as the new normal rather than expecting mean reversion to a bygone era. Now, it's very dangerous to say it's different this time, but today's Mag 7, for example, have earnings power as opposed to the technology names in the 2000 bubble, which had no zero earnings. So some things are different, some things are the same. History does rhyme, but there is something that I thought was interesting to share with you on this opinion. She says quality stocks now make up 60% of the S&P 500 versus less than 50% in the 2000s. And companies on average are more profitable and asset light compared to decades ago, thanks to technology. So with major regions in easy fiscal mode, including the US and the Fed cutting against the backdrop of broadening and accelerating profits, it's not hard to argue for a boom in EPS and GDP growth, Savita concluded. Bank of America itself pointed that the S&P 500 has never been costlier based on readings such as market value relative to US GDP. And the Buffett indicator was all over the news yesterday, that market capitalization is over 200% of GDP, and various price to earnings measures. But that doesn't tell the whole story. She says today's index has a higher quality makeup than prior decade and may be better set up for success, especially if the Fed is cutting, and she thinks this is a higher probability tail in 2026 than stagflation or recession. Now, OECD growth projections are moderating for 2026. But 2025 has been quite increased everywhere. US, Euro area, UK, Japan, India. And the 26 moderation doesn't offset the 25 growth. So if I was to put the 2 years together, really not a bad picture as far as growth is concerned. Global equity valuations are, however, moderate, and we're excited about that. Across global equities, there are lots of opportunities, small cap versus large, value versus growth, global ex-USA versus USA. These are relative charts. And global stocks, as we know, have been underperforming their US peers for multiple years. No one knows for sure, but this could be a multi-year catch-up. And one doesn't have to be down and the other up. It just could be the better performing market. And so diversification at this point is very welcome. Sometimes over diversification leads to too big of an offset, but in this case, we think it's timely. JP Morgan said in March this year that they believed that a combination of factors such as zero commission trading, the pandemic, greater access to leverage, and greater usage of options has brought a structural increase over the past decade in the participation of US retail investors in equity trading, which naturally push up valuation and demand for stocks for sure. So this chart shows you household allocation is higher than it was in the tech bubble in 2000. And of course, people point to this as being overdone. But other investors, more institutional investors, are way below the 2000 highs in allocations. All this is to say that we're seeing buying power, even if you don't believe anything is structurally changed, only have a new cohort in interesting investors. And this is the implied equity allocations by institutional, which I think that it shows that there is more room to buy, especially if global economic growth holds. I mentioned before that sentiment has been very fearful, and inflation is one of those fears. Gold has been acting very well and trading at all-time highs. We're glad to say that we have a decent allocation to this area and have had all year. I will tell you though, not showing on these charts, this is gold futures and gold ETF demand. But not showing on these charts is that 40% of large asset managers globally have zero allocation to gold, and it's trading at a all-time high. So I think that there is some catch up to do. Now, Foreign central banks, however, have started this investment in gold a little while ago, and central banks now hold more gold than treasuries as they seek to diversify away from the US Treasury market, which is really the largest bond market in the world, and that is what they are most exposed to. On oil, on the other hand, not acting so well, despite the fact that global peace has not broken out. But no matter, there's lots of supply. Um, our oil companies in our portfolios, such as Suncor or Imperial Oil, are acting very well and have acted very well all year. Um, these companies have changed over the years and are less levered to the price of the commodity than before, and much more disciplined management and balance sheets, with shareholder return top of mind and throwing off really nice free cash flows. Um, oil, actually, a lower oil plays into the lower inflation um, game. With our names in mind, why don't I move on to the portfolios? This is our current exposure. Over the past month, our financials exposure is down somewhat, but still larger than the index. Same with industrials and materials. Information technology has remained pretty stable at around 11.5%, but so much lower than the 33% in the index. And our corporate bond exposure is in the balanced fund, throwing off a 6% yield with a 3-year duration, which is excellent if you're looking for something very conservative. This is it. We're pretty low in healthcare, consumer discretionary and utilities, and of course, real estate. And cash is minimal at this point. Just before we finish, let me just talk a little bit about some of the smaller cap names we added, where they were suitable in terms of mandate, size, and liquidity. This will be sized and suited depending on the portfolios. These names are not everywhere. Some are in segregated account, some are in the equity mandate, some are in a balance mandate, but let me just take it away. This is Tamarack Valley. This is an oil and gas exploration and production company with exposure to the Clearwater play. And this is, a smaller capitalization than, Imperial Oil or Suncor that I mentioned. Greater than 90% of Tamarack Valley's production comes from Clearwater and Charlie Lake. Producers in this region are using the water flood method earlier in the asset life than traditional reserves, resulting in lower decline rates and longer reserve life. Also lowers sustaining capital and ultimately results in a higher free cash flow profile. The company is expected to grow production between 5% to 10% over the next several years. And the break even for this company is now under $40 a barrel of oil. Oil is now trading at $62. Currently, 60% of the fund flows goes to paying down debt and 40% to base dividends and share buybacks. But once net debt is under 500 million, 20% will go to strategic growth and 80% to base dividends and buybacks. A similar company is Headwater Exploration, that may be in a different mandate, similar looking chart. Also, similar leverage to the Clearwater play. It's smaller cap than Tamarack Valley, so more suitable to certain other mandates. Another name that we just added is Major Drilling. Again, this is a specialty drilling services contractor focused on the mining sector, and its business is leveraged to exploration and mining investment, particularly metals and battery metals like copper and gold. Has global footprint, and revenue exposure tilts towards senior miners. Again, operating leverage as rig utilization increases, currently sitting at around 40% for 25, and generating gross margins of 25%. So their last peak utilization cycle got up to 60%. So there's lots of potential growth there, and their gross margins trended above 30%. So there is some potential there in the chart, as you can see. Looks excellent. There's been quite a lot of eyeballs as the market really increased its risk tolerance and moved down the capitalization curve, as I mentioned. And the last name I want to show you that we've added to the portfolio, perhaps since the last webcast, is Kraken Robotics, ticker symbol PNG. And Kraken Robotics develops and supplies subsea intelligence systems. Interesting company. And robotics surveys services to offshore energy, infrastructure, and oceanographic geological customers. So it's one of the only pure play ways to play the growing defense spending theme through a Canadian stock with 70% of revenue coming from defense. So really strong growth potential across several growing markets. And with that, I will end my recap of our portfolios. Again, we think that despite the possibility of perhaps a short-term consolidation, as pointed out to us by the short-term indicators that we're watching, everything else points to pretty healthy markets globally. Our global equity fund continues to be a recommendation that if you're not exposed in your full asset management, asset allocation, but our equity pools and balance and segregated accounts are all fully invested at this point, as markets in Canada and elsewhere are making 52-week highs. I want to thank you again for joining me. If you have any questions or comments, please contact the Barometer contact that you normally talk to, and they can forward things to me, and I'm happy to answer those questions at the time. For the time being, enjoy the rest of your afternoon and talk to you soon. Dave should be back next week. Thank you.